Subscribe to LearnCab and hit the bell icon to get notified.
Good morning, everyone. Yes. So, friends, today's session, I'm going live mainly for two things. Okay. We'll have two parts over here to cover. Part one, I will be covering the May 2022 RTP. Okay. Now, this has got some very interesting questions. To be precise, 4 problems which are, different from what is normally there in the textbooks and in other places. And part number 2, after we are done with this, I would be liking to give a study plan, okay, for many of you who have been asking for the same thing. All right. So friends, we'll start off quickly with May 22 RTP. Now the time is also less. I will not be going slow. We'll be going quickly from this. If at any point of time you feel that I'm going fast, just let me know. So I will slow down. All right. So we'll start with part number 1. May 2022 RTP. Already, it's already downloaded over here. Fine. We'll now start cracking the problems over here. Friends, we are having in total, we have question 1, 2, question. These are the solutions. We have around 13 problems that is to be cracked in this RTP. And these 13 problems covers from all the areas of SFM. So in a way, the moment we do this, we'll be covering the major concepts of SFM also. All right. Let us take question number 1. The chapter heading is called as security evaluation. All right. We will do this problem now. This problem is a little new. Okay. Before I do any problem, I'll give you a base for the concept of that problem. All right. Now, this is a concept on short selling. Right? Friends, what do you mean by the word short selling? Short selling means you sell first and you buy later. This concept is what we call it as stock selling. Sorry, not stock selling, short selling. Now, this can happen in two markets. One, it can happen in the spot market. When I say spot market, I would mean the real market. And the other one, it can happen in the futures market. Futures market being a derivative market or an imaginary market, here it's very easy to do it. Here you just have to go and sell. The moment you sell, it's possible. But in the spot market, in normal case, you cannot sell a particular stock without owning the stock. All right. That is where in the spot market, if you really want to sell a stock without owning it, you have to go by 2 steps. Step number 1, you have to first borrow the stock, and after borrow the stock, what you can do, you can sell the stock. On a subsequent date, what will you have to do? You will have to buy the stock back and you will have to hand over to the owner. These are the steps that we do in the spot market. And for these steps, ideally there is a scheme in the stock market which is called as the stock lending scheme. Right? I'll just show you that by going to the NSE website. I'll just click NSE stock lending scheme. Hold on. Just a moment, friends. Yes, securities lending and borrowing scheme. If you click over here and if you just go to the NSE website, they'll give you the entire features of how you can do a stock lending scheme on a practical basis. All right. So the RTP question has come based on this security lending scheme. I hope you are all clear with this point now, friends. Can you just write down till here in your books? All right. Are you done writing this? Parallelly write along with when I do in the class, so it will be easier for me to finish it faster, and we can do more number of problems in a less span of time. Anyways, the recordings are also going to be available, so you don't have to worry about it. All right. Are you all done writing this also? Fine, friends. If you are done writing with this, shall we go and read through the first question now? Okay, this is the first question. Everyone just read through the question and understand the question, after which we will do it together. Now, friends, there are a few mistakes in this question. When they brought this question, there's some information they have kept outside, and somewhere they have made some mistakes. I would just correct those mistakes also, and I'll give you the basic data. So I'll write down working note number 1, basic data. All right. Point number A. So here they have told Mr. A is holding 1,000 shares of face value of 100 rupees each. Friends, even though they have given 100 rupees each, the entire problem they have solved it with 1,000 rupees. So what I will do is I will give it over here as number of shares. I'll keep it as 1,000 shares, and price per share, we would take it as 1,000 rupees per share. There's a mistake in the textbook. They have, given the question as 100, but the problem solution is given in 1,000 rupees. All right. He wants to hold these shares for long term as has no intention to sell. On 1st Jan, Messrs. XYZ, another company, has made short sales of ABC's shares and approached Mr. A to lend his shares under stock lending scheme. So now what is XYZ doing? XYZ wants to borrow the shares of ABC. I hope you're clear with this point. Down they have told the duration. The duration will be how many months have they told? This would be 3 months. Next, they have told there will be a lending fee will be 1% on the closing price. Lending charges. They will not lend free of cost. Lending charges will be 1% of the closing price. 1% of the closing price, and there will be bank guarantee on which there will be an interest rate of how much percent per annum? Bank guarantee 8% per annum. And then they have given the rates. Can you write down till here in your books now? All right. Are you all done writing this? Fine. I'll go to the next part now. All right. So once you have written down the whole basic data, now we will start solving it. They have given two scenario. What is the first scenario? They're calling it as bullish. So on bullish, the share price is said to be 1000, 1020, 1040, 1050. Friends, listen carefully. Here they have told the price as 1000. But when they started the question, what is the face value that they have told over here? 100. So down they have given the market price and there is no market value given over here. So maybe we can assume it this way, that here the price per share is 1000 rupees, but the face value per share is equal to how much rupees per share? It will be 100 rupees per share. We can take it that way in that case. All right. So that's the first part of the information. Is everybody clear so far? Arvind, you need a minute more. Please write down. All right. I believe you are done writing this. Now, look at the scenario. All right. On 1st January, the price is 1000. Then the price becomes 1020, 1040, 1050. In this scenario, let us see what is the outcome. So I'll write down now over here the next working note. Okay. Gain or loss in bullish market. I'll put the date. Friends, we are not worried with the 1st January. We are worried only with 31st January onwards. 31st January 2020. Then you have 28th February 2020, or it's 29th in this case. And the last one is going to be what? 31st March 2020. The price is said to be 1020, 1040, and the last one is 1050. Okay. So you have a lending fee over here at the rate of how much percentage? 1%. So how much will be 1% of this? 10.2, 10.4, 10.5. What is the total you will get over here? 31.10 per share. Into how many shares are there? 1000 shares are there, right? That would give you the answer as 31,100. So this is step number 1, lending fee. Can you write down this? All right. I believe you are done writing this. Okay, friends, I believe you are done writing this part. So we have got the first part, the lending fee we have got. Step number 2, we also have to find out the interest on bank guarantee. In the question they have told, it is going to be for the value as on 1/1/2020. On 1/1/2020, the price is how much? 1000. So I'll write down over here, point number A, value as on 1/1/2020 will be 1000 shares into 1000 rupees. So that would turn out to be 10 lakh, right? Just confirm? Yes. On this, you will have interest at the rate of 8% for how many months? For a period of 3 months. Into 3/12. You get the answer as how much over here? 20,000 rupees. Can you write down this also in your books now? I believe you are done writing this also, friends. Now I'll go to step number 3, okay, where I'll write down the gain or loss in the short position. Here I'll write down point number A, current position. Current position is sold 1,000 shares at 1,000 rupees. So can I say that turns out to be 10 lakhs? Right? Okay. So now, what will be the action to cancel this? He will have to buy the entire 1,000 shares at what price? At the closing price. At what is the closing price? 1050. So that should be 10 lakh 50,000. Right? So what is going to be his loss over here? His loss will be 50,000 rupees. All right. So the summary would be, I'll put step number 4, total cost. That would be step 1. How much has he spent there? 31,100 he has to pay, plus 20,000 interest on bank guarantee, plus you have a 50,000 rupees also coming in over here. If you add up all these three, you'll get the total as how much? 1 lakh 1,100 rupees. This is going to be the total loss in situation number 1. Can you write down this in your books now? All right. Are you done writing this? Friends, if you are done writing this, I have given you only one scenario. Now, in the same way, I'll give you 2 minutes time. Can you do the second scenario? Second scenario is not bullish, it is a bearish scenario. The prices are falling down. Exactly the same 4 steps that I did over here, but do it and tell me what is the answer you get in situation number 2. All right. So I'll show you the question based on which you can do it on your own now. Come on, friends, do this scenario now. Situation number 2. Manasa, they have taken the dividend income in the solution. That is another mistake. They have not told anything about dividend income in the entire question. So from where they got that data is also not relevant. So you can ignore the dividend part. Do this method and tell me what answer you get over there. All right. Brinda, where is the other information? I don't think it's given, Brinda. Just confirm and let me know, okay? Satyaravan, yes, I believe your answer is right. So, Brinda, you have a printout taken. In the printout, they are showing a dividend of 25%. Why is it not there in the website? Surprising. Anyway, then that point is clear. If it's there in the information, you can always consider the dividend part also, right? I'll just show you the solution, friends, those of you who are doing it. Now, in the exam hall, if you have a question with dividend coming up, you consider dividend because here in the question, there is no dividend given. 11,200 gain, that is right. So that's the same answer that they have got over here. You can go through the screen, and if you have any doubts, you can let me know. There is a lending fee. Then dividend is there. If that is there in the question book that you are using, RTP is not there. In the online downloaded RTP, it's not available. 11,200. Rasha, your answer is right. See, that is the answer that you get over here. I'll give you a minute more to go through the solution and understand the solution. Then we go to the next question. All right. Fine. I believe you are all done with this part, friends. So we are done with stock lending scheme. RTP May 22. This is a little tricky question. Till now, in your entire practice manual, study material, nowhere they have had a question of this form. So if they bring a question like this, there is a very high probability of asking in the examination. So please mark this question as important. Right? What I will do is May 22 RTP. In my video, I will go in a separate order. We will first do all the heavy problems. Heavy problems in the sense new problems. The type of problems which has not been covered earlier in your study material or in any of the conceptual area. That way, those problems, once you focus it, one day before the exam will be sufficient. And then we will do the remaining problems which are routine, which we already do in classes, which you must have already learned in your study material and other places. Is everybody clear with that part? Okay, so Katiravan, your doubt is that who will enjoy the dividend income? Ideally, whoever is the shareholder should be the one who should be enjoying the dividend income, but it also depends upon the stock lending scheme. That is the reason in this question, if you see, they have not mentioned that in the total cost. If you come down, if you see the solution, they have used the word dividend income per share, but this earnings is not set off against the total gain or loss. So that gives a presumption that this is attributable to the original stockholder. If there is a proper stock lending scheme in which they say dividend also should go to the borrower, then it will go to the borrower. All right. Shall we go to the next part now? Now we'll go to the next question. Question 2 is easy. It is a bond duration of the bond and volatility, something what we have learned. Question 3 is portfolio, very easy question. We will do this later. Question 4 is again on portfolio management, very easy question. It's a question on Markowitz method, combined risk and combined return, very easy. Question 5, of late I'm seeing this question in many places. Even though this is done in the classroom and there is a study material question on this question is an important question. And this question comes on dividend equalization scheme. So let's do this first. Write down the next concept heading. Dividend equalization scheme. I have done this question in my class and the students who have attended my class must be familiar with it. But this looks to be important because I'm seeing this in many places now. So let's do this first. Concept wise, it is the same concept of X dividend, cum dividend that you must have learnt earlier. Suppose we will take one person from this classroom. Let us take Russia. Suppose Russia is holding 1 lakh units in a mutual fund at a face value of 10 rupees. For time being, let me assume that in this company, only Russia is the unit holder. There is no other unit holder in this company. Now, this is as on April 1st. For the period of April 1st to April 30th, let us assume there has been some income of 10 lakh rupees. So 10 lakh rupees means it turns out to be 10 rupees per unit of income has come. On April 30th, let us assume Devadevan wants to join this mutual fund. All right. And let us assume the NAV is said to be the same 10% or sorry, 10 rupees. If Devadevan joins the scheme with 10 rupees only, there is going to be a problem. The problem is that if he pays only 10 rupee, he will still be eligible for the earnings that has come during a period when Devadevan was not even available. It was all Russia's hard work. So what they say is that when Devadevan is coming into the picture, he should bring not only the 10 rupees plus, he should bring another 10 rupees as dividend equalization. Total money that he should bring in should be how much? He should bring in 20 rupees per unit. If he does that, automatically what will happen? He is also contributing towards income. So tomorrow, when they distribute the income, Devadevan will get his rightful income, Russia will get her rightful income. Are you understanding my point? Okay, that is the concept of dividend equalization. Let us say this is for 1 lakh units. You get a total number of amount of how much over here? 20 lakhs will come. So now what will happen? Your income of this company will be 10 lakh rupees of income already there plus 10 lakh rupees of income received now. Total income will become how much? It will become 20 lakh. So suppose they distribute 60% distribution happens, that will be 20 lakh into 60%. How much is that? 12 lakh. This 12 lakh will be distributed. 6 lakh will go to Russia and another 6 lakhs will go to Devadevan. So both are happy in this case because Russia has got 60% of 10 lakhs. Devadevan has also got 60% of 10 lakhs. Can you draw this chart in your books now? All right, friends, are you all done writing this? I believe you are all done writing this, friends. I just slow down. This concept is little heavy. All right, I believe everybody is done writing this now. So let's go through the question now. All right. I'll give you a minute's time. Just read through the question, understand the question, then we will do it together. Darshana, total will be 30 lakhs. I didn't follow your doubt, Darshana. Are you talking about the example or are you talking about this question? Well, I think you're talking about 30 lakh because he brought in 20 lakhs, right? Out of the 10 lakh goes towards capital. Remaining 10 lakhs will only go towards income, right? Whatever comes for dividend equalization alone will go towards income. Right, let's do this together now. I'll draw a chart and explain the same thing to you now. All right. Fine. So on 1st April, so I'll write down the dates over here. Here it is going to be April 1st. On this date, he's having how many outstanding units? This fellow has got 400 lakh units at the rate of 19 rupees per unit. Okay. ₹19 per unit, and then they have issued 5 lakhs on opening NAV plus 2% load. That is called as entry load. When people come in, they bring NAV plus some premium. That is called as entry load, adjusted for dividend equalization. This happened at the end of April. So here, how many units have they told? 5 lakhs, right? At the rate of whatever is the NAV, that is 19 rupees plus 2% load, plus there will be dividend equalization. So basically he has to bring in money to equalize for the dividend. Everybody clear with this part? Next they have told at the end of May, so I'll put it as May 31st, he's going to repurchase at 2% exit load. So here how many units are going back? 4 lakh units at the rate of 19 rupees minus 2% exit load minus dividend equalization, because now when he's going, he will take back his dividend also along with him. Am I right? Sorry, not minus, it will be plus dividend equalization. That money he will take it with him and he will go. But from company's point of view, this will be what? This will be an outflow. Company will have to give dividend. When a person comes into the company, we will receive dividend. When the company is going out of the company, what will he do? We will have to give dividend to them. Am I right? Right. And after that, on June 30th, 60% of the income is distributed. All right. Now down they have told that income for April is going to be 31 lakh 96,000, 46 lakh 12,500, 58 lakh 47, and for the all the entire period there is a portfolio appreciation of 515 lakh 67,000. Can you draw this chart in your books now? Okay, are you all done writing this? We'll do all the heavy problems first and swallow the big frog first. So that way you will be all comfortable towards the end doing the easier ones. Done. I believe you're all done with this. So friends, I'll just show you with this how much will be the money that will be brought in on April 30th. That will give you clarity on what I'm trying to say. Okay. Amount, I'll write down the next working note heading. Amount to be brought in on April 30th. Point number A, we'll call it as opening NAV. So now tell me here how much is the opening NAV? 19 rupees. Add 2% entry load. So how much is 2% on 19 rupees? That will be 0.38 rupees. So do I get the answer as 19.38 rupees? Now what will happen? We have to add and adjust it for what? Dividend equalization. That fellow has to bring in 19.38 also, and he should bring in the money for dividend equalization also, right? So that would be, you have 31,96,000 is the total income that has come. All right, that is for how many units? 400 lakh units, right? So 31,96,000 divided by 400, if you do, you will get 0.0799 rupees. This is going to be accounted as my income. All right. So what will happen? 19.38 I already have, plus 0.0799 if I do, I'll get the answer as 19.4599 rupees per unit. Can you write down this in your books now? All right, friends. I believe you are all done writing this. Fine. So I believe you are done with this part. So this is how the fund comes in, and this 0.0799 will be accounted as what? It will be accounted as your income. So I'll just show you how your income statement will work now so that you get a better clarity on the entire thing. All right. First, I believe everybody is done writing this. Okay. So I'll just write down the next working note. Here I'll write down analysis of income statement. So I'll write down particulars. I'll put units. I'll write down per unit and I will write down total. All right. Whatever is the balancing figure, I'll write down with a red ink pen so that you can understand it better. So I'll start with income for April. Now in April, how many units are there? 400 lakh units are there. And I think we got the total income as 31 lakh 96,000. Correct. So if I do it on a per unit basis, what is the answer I get? 0.0799. I'll take a red ink pen and write down over here 0.0799. Isn't this the same thing that I got earlier also? Correct. Now what will happen? At the end of April, I have to make an adjustment for dividend equalization. How many units are coming at the end of April? 5 lakhs. So on these 5 lakh units, we ask those fellows to pay us 0.0799. Am I right? Once he pays this, I will be getting extra earnings of 0.3995 lakhs. Yes or no? So that becomes my additional earnings apart from what I already had. So once I get this, I will take the total. So now what is my total? Total will be 405. This will remain at 0.0799. Here you will get 32.3595. All right. I believe everybody is clear with this part. I'll give you a minute. Write down till here. Then I will go for May. I believe you are done with this part, friends. I'll now go to May. Now tell me, in the month of May, how much income you got over there? Let's go and check it. You have an income of 46 lakh 12,500. Correct? This is for how many units ideally? This is for the same 405 lakh units now. 46.125 divided by 405. Do I get the answer as 0.1138 or 0.1139 to be precise? Okay, I'll do one thing. I'll put this with the reading pen because this is what we found out over here, right? So once this comes in, what becomes my total income? For the same 405 lakh, it will be 32.3595 plus 46.125, 78.4845 will come over here. Okay, and here it will be 78.4845 divided by 405. That will be 0.1938. That would be nothing but, yes, this will be the total income. Now what will happen? At this point, there will be some people who are going to leave the company. So again, what will come over there? Dividend equalization will come. How many units are going now? 4 lakh units are going. So for these 4 lakh units also, we will end up paying 0.1938. So 4 lakh into 0.1938 will be 0.7752 lakhs will be my outflow. This much of my income will go from my hand. So my balance income would be how much? It will be 77.7093. That is nothing but 0.1938 and here it will be 401. Rest I'll show you from the textbook itself, friends. This way we have to keep doing the calculation for June also. Please write down till here and understand till here. All right, friends, I believe you're all done writing this. I'll just show you the solution now. We have done until May. Look, I'll just come back, come down. And you were doing question number 5, right? Yes. See, we have done up to here, up to May we have done. And we have got this answer, 401.1938 and 77.7093. Now, same way what will happen, we have to add the income for June. 58 lakh of income is coming. And you will get the total over here. From this total, 60% has been distributed. So 136.1793 into 60% will give you how much? 81.7076. So can you write down this table and finish it off, friends? I believe you're all done writing this now, friends. Can I go to the next part? Yes, I believe you're all done with this. Okay. So friends, now the remaining part is very, very simple. This one we have already done. Opening NAV we have taken. We have added the entry load and we have added the dividend equalization, right? On repurchase, you have the opening NAV minus whatever is the exit load. But along with this, we have to pay him dividend. So dividend is 0.1938. How did I get this 0.1938? I got it from here. See, it's already shown in the income calculation over here. That is the dividend per unit that we will be offering. And once you do that, you get the answer as 18.8138. Can you write down this in your books now? Once logic is clear, then the remaining part becomes very easy. Darshana, are you still writing? I'll just show you. Please confirm, Darshana. All right. Please write down this repurchase price. The main challenge is understanding the logic as to why they are adding. I think that's clear. All right, friends, I believe you are done with this. Now we'll go to the final step, closing NAV. That's also very easy now. You have the opening value of the asset, 19 units at 400 lakhs. You have portfolio appreciation given. issue of fresh units, whatever money you have got, income received, they have added over here, units repurchased, income distributed. Once all this is done, you get the closing net assets. So this is nothing but a summary of whatever we have done all the while. Can you write down this in your books now? I believe you're all done with this. All right, friends, I believe you're all done. Arvind, you're still writing. Please write it down. All right, friends, I believe you're all done with this part now. I'll go to the next one now. So we are done with this question also on mutual funds, which was a heavy problem. One stock lending scheme was a unique problem in May 22 RTP. Then the unique one was this mutual fund. Not a unique one, but this is actually an FR related question which is keeping on coming in SFM. So I thought of covering that. Question 6 is the question on call option. Very easy. Question 7 is also a, what do I call it? This question is there in the study material from a very, very long time. It is a question on shorting about futures. And this is already covered in the class also. I will do it in the next part. 8 is a unique question, something different, what we have not done, and a very good question. Okay, it's a question on foreign exchange management. Let's read through it now. A US investor is investing in the Indian Sensex. So what happens? The investment size is coming to 20 lakh dollar. I'll write down over here. Working note number 1, basic data. Whatever is the dollars invested. So tell me, how many dollars are invested over here? 20 lakh dollar. Friends, this question, how they have given it is, they have invested 1 year ago and they are going to retrieve the money today. That is how the whole question has been drafted. Suddenly, when you read, you will not understand that part. In the first, who gives the bank guarantee? Aditya, bank guarantee is given by the borrower to give a promise that tomorrow he will buy back the share. Correct? All right. Now, friends, I need to ask you a question, even though it will take some time for me to wait, it's okay. 1 year back, that fellow comes to India with 20 lakh dollar. So he will come to India with 20 lakh dollar and exchange that into rupees. Will it be the bid rate or will it be the ask rate? Come on, think and tell me. Aditya, no, it is XYZ who will pay. Darshana, you said it's bid rate. Your answer is right. We sell dollar to the bank. Bank buys dollar. Dollar being the commodity, it will be the bid rate. So I'll write down what was the bid rate 1 year ago. How much is that turning out to be? Do you get the answer as 42.5 rupees per dollar? Correct. So total investment made in rupee would be 20 lakh into 42.5 rupees per dollar. So do you get the answer as 850 lakh rupees? Correct. This much of money has been invested where? It has been invested in the Sensex. So let us come back, come down. 1 year back, what was the Sensex value? It was 3256. Now, what is the Sensex value? 3765. So can I find out the closing value of investment? Closing value of investment will be 850 lakh was invested at 3256 and now it has become 3765. So I get the closing value as 982 lakh 87,000 rupees. This much rupees, what I will do now, I will take it and I will convert it at the today's rate. Earlier, I was selling dollars, so it was the bid rate. Now, I am going to buy dollars, so it will be the ask rate. So, what is today's ask rate? So, I'll write down now closing value of investment in dollars. So, that would be 982.87 lakh divided by today's ask rate 43.90. I will get the answer as 22 lakh 38,900 lakh dollars. So from this I can find out after considering inflation and everything, my nominal rate of return will turn out to be alphabet E divided by alphabet A. So that will give you 22 lakh 38,000 divided by 20 lakh. I'll be getting the answer as 111.9 minus 100 if I do 11.94 percentage. Can you write down till here in your books now? Are you all done writing this, friends? Darshana, how come 11.94? 20 lakh dollar was originally invested. I'll just highlight that and show you. Okay. Originally, how much was invested? 20 lakh was invested. This now became 22 lakh 38,000. Just find out the rate of return, you will understand. Yes, Arati, you're right. Because of these two things, you get a return of 11.94%. Are you all done with this part? All right, friends, I believe you are done with the first requirement. I'll go down now. First requirement was compute the nominal rate of return for the US investor. So nominal rate means the final return after considering everything, after considering exchange rate, after considering inflation, after everything, we got finally 20 lakh was invested. Investor is getting 22 lakh 38,000, right? So his nominal rate of return turns out to be how much over here? 11.94%. Everybody clear with this part? Right. Let us read the next question. Compute the real appreciation or depreciation of rupee. So now they want to know whether rupee has really appreciated or depreciated. Friends, we have learned, I'll just explain the concept once again. There are two types of discount rate. DR is discount rate. RDR is what? Real discount rate. MDR is money discount rate. Real discount rate is without considering inflation, whereas money discount rate is after inflation. Everybody clear so far? Wait, there is a doubt, Aditya. In this sum, can we find out how much is the return due to Sensex and how much is due to currency appreciation? Aditya, they are the upcoming requirements. By the time we complete that, you will understand those requirements also. Right? So RDR is without inflation, but MDR is after inflation. Now let's read the requirement again. Compute the real appreciation or depreciation of the rupee. Now listen carefully. We will take the bid rate first, then we can do the same thing for ask rate if required. Okay, I will write down over here real rate of appreciation or depreciation. All right, first I will write down spot rate 1 year ago. So 1 year ago it is 42.5. Everyone tell me 1 year ago will be what? Will it be real or will it be money? 1 year ago will be real. That is the base with which we start off. All right. Now, spot rate today that is given in the question is 43.85. This one is what, real or money? This will be money because there will be an inflation effect also coming on to this. So now what we have to do, we have to find out, this is the money spot rate today. We need to find out the real spot rate today. How do we find out this? We can find out this using purchasing power parity theory or interest rate parity theory. 1 plus IH divided by 1 plus IF is equal to forward divided by spot. So here, how much is the inflation in India? In India is 9%, so the formula would be 1 plus 9% divided by what? 1 plus 5% should be equal to 43.85 is the forward rate. It is today's rate. So this is the money rate divided by, if that is the case, what would be the spot rate excluding inflation? So once you do a backward working, you would get the answer as 42.24 rupees per dollar. This is going to be your real rate today. Everybody clear so far? I'll give you time to write down. So I'll write down over here. Okay. 1 year ago, the rate was 42.5 rupees per dollar. Today, what is the rate that you have got over here? Have you got the rate as 42.24 rupees per dollar? All right. So now tell me what is happening. Dollar depreciates. And what happens to rupee if dollar is depreciating? Rupee will appreciate. Why is dollar depreciating? From 42.5, it has fallen down to how much? 42.24. And the formula would be 42.24 minus 42.5 divided by 42.5. Whatever comes on the right will come down also. You will get the answer as minus 0.611 percentage. And here the formula would be 42.5 minus 42.44 divided by 42.24. You'll get the answer as plus 0.615 percentage. Friends, they have done this for bid, they haven't done it for ask. You can do the same thing for ask if required. Can you write down this in your books now? Brinda, your question is in requirement number 1, shouldn't we consider the inflation rate? Brinda, already the closing rate, that is the rate today, will be after including inflation also. So that is the nominal rate of return itself. We don't have to again add inflation because the rates are already inflated. That is why in requirement number 2, we are trying to remove the inflation effect. For example, I'll just explain that to you once again. When I say that this is the Sensex, this is after considering inflation also. And when I take this 43.9, this is also after considering inflation itself, Brinda. I hope you are clear with this part. Suraj, yes, the real rate is theoretical because in reality, everything will be after inflation. Are you all done writing this? Please write down this also. Believe you're done writing this also, friends. Can I go to the next requirement now? All right. We are done with appreciation of rupee. What should be the exchange rate if the purchasing power parity theory holds good? I'll write down the next working note heading. Exchange rate if purchasing power parity theory holds good. All right. If this is the case, I'll do it first for bid rate and then for ask rate. For bid rate, the formula would be 1 plus inflation in the home country, 1 plus 9% divided by 1 plus 5% is equal to forward divided by, today the spot rate is how much? 42.5. So what's the answer you get over here? Do I get the answer as 44.11? And Roman number 2, I will put the ask rate. Forward divided by spot. So here it will be 42.60. I'll get the answer as 44.22. So the rate should be 44.11 hyphen 44.22 rupees per dollar. Can you write down this in your books now? I believe you are done writing this also, friends. I'll go to the next part now. And the last requirement. Last requirement is what will be the real return to the Indian investor in Sensex? Friends, I'll write down the next working note heading. Real return in Sensex. All right. For this, Step number 1, I will find out the money return in Sensex. Money return means return after considering inflation also. So here I'll put it as 3765 is the final return divided by 3265 minus 1. I'll get the answer as 15.31%. All right. Now from this, I need to do what? I need to remove inflation. So we have already learned an equation 1 plus RDR into 1 plus IR should be equal to 1 plus MDR. Correct. So in that case, can I say 1 plus RDR is equal to 1 plus MDR divided by 1 plus IR? So that would be 1.1531 divided by inflation in India is how much? 9%. I'll get the answer as 5.79%. This is the real return. Please write down and finish it off, friends. How did I get 42.6? Yes, Chitra, that's given in the question. 42.6 came from here, the spot ask rate. All right. Please write down this now. Are you all done writing this? Have I done a mistake? Is it 3256? I'm so sorry. I have taken 3265 by mistake. Thank you for correcting me. Will the answer change? Just check and let me know. It will be 3256. It will be 15.63 over here. Okay. There will be a small change. It will be 6.08% will be the real return. Okay. That was a clerical mistake, friends. Thank you for correcting me. 6.08%. Thank you, Amrita Priya. I believe you are all done with this part, friends. Shall we take a break now? Friends, originally I thought of a 6-hour session, but this is getting faster than what I expected. I think we need maximum another 2.5 hours to complete off the entire thing. So why don't we take one little longer break, and after that sit for 2 hours and finish it off completely. And in the end, I'll be giving you a 30-minute of study plan for the exam point of view. So that way we can finish it off early rather than keeping it for the afternoon also. All right, friends, I believe you are done writing this. What's the time now? Time is around 8:15. Let's take a 30 minutes break. 8:45 we'll get back over here. Two more questions are there which are tricky. Question 9 is little tricky. And question 10 is a question on GDR, Global Depository Receipt. Remaining are all routine, similar type problems. Not much difference at all. All right. So let's take a 30 minutes break, friends, and we'll get back after 30 minutes. Thank you so much.
Subscribe to LearnCab and hit the bell icon to get notified.